What's up, boys? Hit that share button, hit that like button. Let's get it going today. What an amazing day it is. Another day to get it right. Another day to get it right. Good morning and welcome everybody to the Crypto Mining Show, your one-stop shop for all cryptocurrency news from the perspective of a cryptocurrency miner. I go by Blind Run on the internet and Matthew in real life, and I'm shaking up my gamer subs right now. Yes, they're an affiliate partner, and I only get paid if you order from them. If you use promo code SOAT and pay with Bitcoin, you can get a Bitcoin shaker. This one is actually Thorn's Thoughts, who's apparently a streamer on Twitch that I haven't heard of, and I need to go check out. Today, we're going to be covering all the goodness from graphics card prices dropping all the way to stETH and staked ETH basically running out of liquidity in the liquidity pools, along with, of course, your traditional mining profitability that is in the gutter. That obviously relates to the GPU pricing and Bitcoin recovering as Fed commits to slow inflation, but then, of course, dumping again right away. So this is all good stuff and bad stuff wrapped into one big ball. All the news you need for the week. And it's Friday. So welcome, everybody, to the weekend. We got Father's Day tomorrow. So that means tomorrow we will be in the evening doing a live members-only stream on the locals page at sonofatech.locals.com, where we will be giving away the ETC MAYC NFT. So if you're interested in that, go check it out. We're going to bump that light up just a tad. And let's get into it right after a word from today's sponsor. Today's sponsor is Crypto.com. Crypto.com is my go-to centralized exchange for liquidating my crypto assets. With their Crypto.com Visa debit card, I can load up my mined Ethereum to pay for power and other operating costs quickly while earning up to 8% cash back. In addition to the Visa debit card, there are additional fiat options, including wire transfers, to easily receive your profits. Crypto.com also offers additional services, including trading and even staking, to earn additional revenue on your investments. Join 10 million plus users buying and selling 100 plus cryptocurrencies at true cost by using my affiliate link in the description for a $25 funding bonus. Or enter referral code SOAT at sign up for the same bonus. Remember, cryptocurrency investment comes with significant risks, so do your own research. Welcome back, everybody. So first things first, we have a huge crash in the price of GPUs, of course, coinciding with the crash of cryptocurrency. We have a couple different articles here. I want to cover both of them because it's a really interesting topic when we get into it and the way different outlets go ahead and approach it. Obviously, we are going to start with the most negative side typically, which is videocards.com. And they are, as you guys know, traditionally very, very, very against cryptocurrency mining with GPUs. So let's get into it. The title is Graphics Cards Pricing Plummet Under MSRP as Cryptocurrency Crashes. The most recent cryptocurrency crash is creating a new opportunity for gamers to buy graphics cards at even lower prices. To their chagrin, what I'll tell you is it's creating a great opportunity for crypto miners to purchase graphics cards at even lower prices. With Bitcoin and Ethereum losing 30 to 40% of its value in the last week alone, miners begin selling their graphics cards as they are no longer profitable enough to mine with. Now, from our perspective, obviously, like we've been talking about, the only way to combat this is reducing cost and increasing hash rate. pretty much that's going to be your goal. And so the number one cost is going to be your power cost. And from there, of course, you should take a look at increasing your hash rate if at all possible. And this is the opportunity to do so. This is creating a new problem for board partners who already had an excess of GeForce RTX 30 and 6000 graphics cards at their hand, but also giving gamers a lot more choice to find new graphics cards. Here's another thing I wanted to point out, because I go to Micro Center quite a bit. And for about the past year, maybe a little less, let's say the last 6 months, Micro Center has had just shelves upon shelves of GPUs, specifically 6000 series. And if they would have taken those MSRPs and brought them down on the 6000 series, specifically like the 6800 XT, I think they could have really liquidated a lot before this got extremely difficult for liquidation when everybody started selling their GPUs on third-party markets like, of course, eBay, etc. And I think there was a missed opportunity there from AMD, and I think they should have taken kind of a more practical approach to it, knowing that this is a possibility, right? And seeing that they had a bunch of stock on shelves. Now, this is where retail and used market collide, creating a massive influx of graphics cards. This is nothing new. We saw this last time as well with, of course, the cryptocurrency crash of 2018 and graphics cards flooding the market on eBay and all of that, Facebook Marketplace, whatever it may be. And so just as we saw in 2018, they say, reports Tom's Hardware, it is still too early to tell how the market responds to this crypto crash in the long term. But there are many miners that are not willing to wait for Bitcoin to bounce back. Some miners who already bought the cards at much higher price know that the profitability and ROI shrinks by the hour. The only choice they have is to sell their cards right now. That is not the only choice that you have. There is, of course, still the potential to turn them off and wait for the next bull run cycle. And the thing is that I think a lot of people miss here is even the Polaris cards were selling for over $200 a piece in the next cycle, and those cards are old as dirt. So this is kind of a weird spot to be in. We saw it with the L3 Plus as well, which is an ASIC miner, where you were able to pick them up on the used market between $75 and $100 a piece. And then once it hit again, those were selling for up to $1,600 in the market. You can make money just buying and holding silicon. So once again, like I say, I don't hodl crypto, I hodl silicon. That's what I do as a miner. And that is basically your other option. And it's a viable option. Even if you aren't ever intending to mine with that hardware. Tom's Hardware GPU market analysis shows that more and more cards are going green, which in this case means going under MSRP, suggested retail price. Some cards, mostly from NVIDIA upper mid-range segment, are still resisting the pressure, but this is where the used market can pull the pricing down. Overall, retail GPU prices have dipped by 2% in just 2 weeks. They misspelled this and said dripped. Silly guys. But this is mainly because most AMD RX 6000 series are already at MSRP. But remember, with AMD in the 6000 series, we have an inflated MSRP. They need to bring those MSRPs down to actually truly represent what it would have been without the cryptocurrency market skyrocketing, right? Another thing about this that is important to take into account is there were a ton of GPUs from NVIDIA that were being sold directly to large miners and to nobody else. And this is an interesting aspect of it in general, because what you're talking about is there was a bunch of silicon there that didn't go out to the general public that did require basically other manufacturing. And that manufacturing now has to be repurposed back to the gamer side. So you end up kind of putting these constraints on NVIDIA and AMD to retarget the market. That's why early on you see these kind of implementations of things like light hash rate unlock or light hash rate locks. They were intentionally doing this to kind of make sure they kept the gamer base happy for when this happened. It makes sense as to why they would do that. But in the background, of course, they're still participating in the cryptocurrency mining portion of things for big sales. The used market is not waiting for price cuts. People are already selling cards under MSRP. On average, the prices dropped by 10% in 2 weeks on eBay, and that's not even including the lowest prices. Tom's Hardware comparison also includes Buy It Now, which lists the lowest price available on eBay that requires no bidding. These prices are, of course, lower than the average price as listed in other columns. Interestingly, some cards can still be purchased at even lower prices. Some scalpers, miners, and enthusiasts, you name it, are selling 6 RTX 3080 cards in one box, all for $2,500 US. That seems a little crazy because I would pick that up personally. I didn't see that one. I'm sure that is probably not as common as you may expect, but that's just $417 a piece. But those are just extreme examples of what you might expect to see on the used market in the coming weeks. As you can see here, they have a whole list at the top. They kind of have the most expensive one, the 3090 Ti, which is the MSRP of $2,000, retail of $1,900, and retail of June 15th, $1,800, and their average eBay costs. I think in red here is where they have the biggest drops potentially, or are those the ones that are overpriced? Those are the ones that are overpriced. Here on average eBay, $899. I think in the green is under. So let's see if we can pick out a couple interesting ones. The 6800 XT, like we already predicted via the Steam charts, is still a little overpriced, but there are some buy it nows for $570. That's really intriguing. The 3070, as expected, is a little bit more expensive, as you can see here on the average eBay cost. But there are some buy it nows for $499, which is pretty good. If we go up to the, let's see, the 3080, you got $641 on the buy it nows, and the $899, the $743 with that outlier of the $471. A lot of these you're not going to want to mine with, like the 6400 and the 6500 XT. So those make sense. They're probably going to come down quite a bit. If we take a look at the 6600 XT and the 6600, these become more enticing at $277 and $270 a pop. They don't have others listed on here like the 1660 Super, which are really coming down. And if those get to where I would expect them to be, I would think you can start picking up the 1660 Supers for $75 to $125 a pop. Not dissimilar from the GTX 1063 gig on the previous cycle. Now, I do have one more article to cover here. Interestingly, video cards didn't take any shots at crypto miners, so that's fun. But miners devastated by cryptocurrency crash run to reseller websites to offload their wasted graphics card inventory investment, and that's coming from WCCF Tech. And this is just basically going to give us the same information, just from a different perspective. They say the shifting graphics card prices and crypto miners selling their GPUs is fantastic for gamers and power users, but how does it affect the retail marketplace? In the last week, cryptocurrency has fallen with losses of 30 to 40% in value for Bitcoin and Ethereum alone. This rapid decrease in value has caused miners to believe that their graphics cards have lost their use due to lesser daily gains. Tom's Hardware points out that the marketplace between retail establishments and used markets like eBay is beginning to crash, similar to what we see in 2018 or saw in 2018. While we still do not know how this will affect the marketplace long term, which in my opinion we do, because we can still look at 2018, we're going to see, like I said, probably those 1660 Super somewhere between 75 and 125. We'll see a huge crash in the stock prices of NVIDIA and AMD, specifically the Radeon departments and the GeForce departments. And we will start to see that kind of shake out. We'll start to see buying limits lifted on places like Micro Center, Newegg, etc. And this is the opportunity. Now, this isn't financial advice, but this is where the opportunity lies. This is how I got myself prepared for the last bull run, and it's cyclical. Now, I do need to offer myself basically a correction between super cycle and halving cycle. What I refer to most of the time as the super cycle is actually the halving cycle, so I want to make that clear. I'm going to be making a specific video on the difference between that later on, but I want to make that correction here today, and that's thanks to, of course, a comment. And so I appreciate that from you guys on the correction. With the return of the investment or ROI now affected hourly instead of daily, miners are rushing to make back what money they can from investing in GPUs and crypto mining rigs. The website has tabulated the pricing from the last few weeks between MSRP of its NVIDIA GPUs, which happen to be the most popular brand of crypto mining, and eBay pricing. The below table shows their findings from the beginning of this month to 15 days later. And as you guys know, we already covered this chart on video cards. From the findings, NVIDIA and their higher mid-range graphics cards are still slowly dropping in price, but not to the level that we are seeing the second-hand market dropping those prices even further. Pricing on graphics cards has decreased by 2% over the last 2 weeks. It is speculated that the rapid drop is caused by the recent release of AMD's new RX 6000 series GPUs coming in at MSRP set by the company. Unless AMD decides to take this opportunity to run a line-wide sale, this could lower the overall cost of the entire GPU marketplace. We also see miners selling their GPUs well under the suggested retail price, decreasing as high as 10% on eBay over the last 2 weeks. They mentioned the same set $471 GPU price package sale of the RTX 3080. And they say, will the used marketplace become even more appetizing for consumers looking to score great deals on GPUs? And they say maybe. I would say probably yes, at least until, once again, the halving cycle takes over into 2024. And in my opinion, even if you aren't going to mine, now is the opportunity that you have for essentially what we would refer to as hodling silicon over here on this channel. If you purchase a used GPU off a site that has been used for a meager price, be wary of the warranty and consider the actual lifespan of the graphics cards. Many cards used in the crypto mining are stressed incredibly high levels, causing the card to have minimal use life. This is partially true and partially untrue. I'm going to create, basically, for the gamers, a guide to buying used mining graphics cards here shortly, because I think that will be advantageous, and I think it will be advantageous to the miners as well. But a few things that you could take a look at right off the bat is making sure that it hasn't been copper modded. The reason you don't want it to be copper modded is because copper modding does put pressure on the PCB, unexpected pressure, out of spec pressure on the PCB that could reduce the lifespan of that GPU. Should also be talking about any sort of replacement of thermal pads, etc. I would avoid cards that have been replaced with thermal paste as well, because it's harder to clean up and refurbish the card. I would also ask about the removal of fans, fan replacements, and dust management, if at all possible, and keep all of those things in mind. The biggest thing that you will have to deal with on used GPUs is going to be the fans, due to the dust and the high RPM that a lot of these newer cards are required to run. Really 70 to 100% on the RTX 3000 series. It was not as big of an issue the previous halving cycle, because what we saw was those the RX 580s, the Polaris GPUs, really only needed to run at 30% to 40% on the GPU fan speed, and this really wasn't an issue. We also had much higher quality fans, I think, on that series than we've had recently. So when you're looking at the GPUs for the used market, just keep in mind that you want to make sure that you have some sort of fan replacement option to go in with it. Now, if you're doing it for mining specifically and you're going to be mining yourself, removing the fans completely and putting them into a server case is probably advantageous. Plus, you reduce your power consumption as far as that goes. So that's kind of the quick tips here. We'll do a detailed guide for you guys later. I think that that'll be super important. I want to say thanks to everybody for hitting the likes. It's already hit the like, and go ahead and hit the like button if you enjoy this content. We're going to be talking about some more, I guess, predictions. This is coming from Forbes. So this is outside institutional money type investing advice. This is not within the cryptocurrency market. They tend to miss a few things within cryptocurrency that are like nuanced, that I think you need to keep into account. But we're going to read this opinion piece. This is basically saying you don't have a bottom until you have an event, and they are saying that we are not at the bottom for cryptocurrency yet. So let's get into it. Shark Tank Star issues stark crypto prediction as price of Bitcoin, Ethereum, BNB, XRP, Terra's, Luna, Solana, Cardano, and Dogecoin go into freefall. The crypto bleed out Can you get rid of that so I can read the article? Forbes is always a little frustrating. Got it. Okay. The crypto bleed out continues. Over the past week, the Bitcoin price lost about 1/3 of its value, hitting a low of just over 20,000 US dollars, but then recovering to 22,664 at the time of writing. Altcoins are bleeding too. Ethereum's price fell 31%, Cardano fell by 16%, Solana dipped just under 10%, and XRP, BNB, Dogecoin, Terra's Luna are down 15%, 24%, 30%, and 23%. And 23%. Is the bottom near? While it's hard to see in murky water, Shark Tank star Kevin O'Leary, who made a killing at the height of the dot-com bubble, says he doesn't believe we've hit the bottom just yet. You don't get a bottom until you have an event, he told CoinDesk this week. What kind of event are we talking about, Kevin? Before we let him answer that question, let's take a good hard look at what's going on in the crypto markets as it dumps. Even though we've seen the number of such events, including Terra's collapse and the implosion of the biggest crypto lender, Celsius, they were more an effect rather than a cause of the broader risk-off sediment than risk assets. See, when we're talking about events, that's kind of where I disagree. I think we've seen some big events. I think we have one more massive event that we're going to talk about today that I've been warning about for a while, which is specifically stETH, which is a wrapped version of staked Ethereum that's been staked and cannot be unstaked. So I do think we have one more big event, and I think that we have the potential for the collapse of DeFi. I don't think that necessarily translates into Bitcoin, though, because you have that kind of standing alone by itself. The collapse of wrapped Bitcoin, yes. The collapse of Bitcoin, not necessarily. But we could see a complete collapse of Bitcoin, of DeFi in general, which could affect the broader market. And that's kind of where I sit as far as events. We did have a huge event, though, in Terra's collapse. It's interesting that they're saying this is an effect rather than a cause. So this is kind of funny because they're saying this isn't the type of event that Kevin O'Leary is necessarily referring to, even though I would argue that it would be this type of event. Who's to blame for this route? Many analysts pin it on stablecoins. However, it's likely the other way around. The crypto market has been chugging downhill since May 4th, which perfectly coincides with the Fed's half-point rate hike. After that, stocks crashed and the tech-heavy NASDAQ lost 13% of its value. That makes sense. Cryptos are highly correlated to risk assets, especially tech stocks. And since they have a higher beta, they work as a de facto amplifier of stock moves. Some analysts compare this sell-off to the tragic bursting of the first major crypto bubble back in 2018. It's interesting that they always miss this. All these big publications always miss the halving cycle. It's really, really funny to me that they always miss it. After going parabolic and blasting past $19,000, Bitcoin lost 80% of its value within a year. But unlike today's sentiment-driven implosion, that crash was largely a result of a chain of panic events. On January 12th, rumors began circulating that South Korea was preparing to ban crypto trading. 2 weeks later, Japan's largest cryptocurrency market, CoinCheck, was hacked and staggering $530 million worth of crypto was stolen. Are you guys seeing the parallels here? Are you seeing the parallels of the pattern of what happens? Bitcoin begins to tank, regulations start coming in, threats of bans start coming in, you have hacks start to happen everywhere. This is the same thing. I want you to take solace in this fact that the same thing that happened before is happening again. It's just at an accelerated rate because we are in the digital age now. Then, in early March, Binance lost control of private key, wreaking havoc on the largest crypto exchange. Later that month, the final nail in the coffin was pounded in when Facebook, Google, and Twitter all banned crypto trading ads. Not to mention that all institutional investors laughed off crypto as a Ponzi scheme back then. We're starting to see this too, and a really interesting tangent, I suppose I'll say, is what's been happening on BitBoy Crypto's Twitter. I'll let you guys go read that and take into account for it what you will. And then his talks about how everything outside of proof of work is now all of a sudden a Ponzi, according to him. Now, we're obviously pro proof of work, and I'm glad that he's starting to see the light, but I think that it's a little bit of putting everything in one single bucket, and I think that there's some nuance there that maybe I have missed. However, BitBoy Crypto is the one to watch right now, I think, in my humble opinion, because you're going to get that larger audience sentiment surrounding cryptocurrency as he responds and starts freaking out to the first kind of crash as a cryptocurrency YouTuber. And depending on how he reacts, it's going to influence the larger market, I really do think. So I think it's really interesting to go see kind of what's going on there, how he's responding to, you know, all of the sham coins and stuff that were going on, especially as he was, you know, exposed by a couple different outlets that I'll leave to you guys to do research on. The interesting part, though, is how he's responding to it, specifically as it pertains to proof of stake and proof of work, as well as the Celsius situation. I think that it's definitely important to pay attention to. Many early crypto investors thought it was the end of the world. We all know what happened in the years to follow. Even at today's price, Bitcoin is up more than 3 times in under 3 years. Nobody can tell where crypto will be next month or by the end of the year. But one thing is certain, if recent market actions teaches us anything, crypto markets won't reverse course until investors regain their risk appetite across the board. It's a lot less to do about that and a lot more to do about the cost of electricity to produce a Bitcoin. Not to mention the halving cycle. Once again, all of these large outlets always ignore this and then leave the public to fend for themselves without the knowledge of how the technology is working on the back end. What will end up happening inevitably in 2024 is that the minting of Bitcoin that is paid out to the miners will be cut in half, thereby reducing the miner rewards and the cost to produce a Bitcoin, which will obviously, as always, initiate an initial bump in the price of Bitcoin. The larger public will see this bump. They'll attribute it to some larger risk appetite of investors, and then hopium will start up again, and you'll have that entire market start to boom again. It is easy to see that. That's what's a little frustrating about this when they say that. And this isn't financial advice. This is just me looking at what's happened in the past and what continues to happen today. For that to happen, we will have to get some clarity to several macro headwinds, including the worst inflation in 40 years. Now, this is the aspect that I don't have any knowledge on, admittedly, and how this inflation is going to impact. Remember, the inception of Bitcoin was surrounded by the 2008 financial crisis, the housing market crisis, and it was a response from Satoshi Nakamoto in particular to that. It was a way to hedge against inflation originally. Now, what we're seeing is nothing really new for Bitcoin. The question will be, of course, is will this inflation influence Bitcoin to follow along traditional risk assets and go down in price further below the cost to produce or mint a Bitcoin? And that's where really the question will come into play. A part of that will correlate to the hash rate on, of course, the network. And that is because the amount of hash rate on the network will determine the difficulty to mine a Bitcoin, which will then directly influence, of course, the price of Bitcoin. So you kind of have this weird play where we've talked about before. Typically, you see the price of Bitcoin go up, you see the hash rate of Bitcoin go up, you see the price of Bitcoin go down, and you see the hash rate of Bitcoin go down. It looked like that maybe wasn't happening as more hash rate was going onto the network while the price of Bitcoin was going down, at least early in the year. But now it's shifted back to what we expect. So as the hash rate of Bitcoin goes down due to miners getting priced out, the cost to mint a Bitcoin will go down as well, which could influence, of course, the price of Bitcoin to go down too. These are all different factors and nuanced factors within cryptocurrency that are outside of traditional markets that are often missed by publications like Forbes. The good news is that Root is cleansing the market of overhyped assets, and multi-billion-dollar wipeouts are urging lawmakers to create a clear regulatory framework for digital assets, which can boost their institutional adoption in the long run. Oh, boys. I'm not a fan of that personally, right? So When we're talking about more and more regulations, this is the same thing, though, that happens every single cycle. So don't be surprised by it. The question will be is how far ahead do they push this? How much regulation will they put on the industry? And how much appetite do institutional investors have for cryptocurrency with the down market? Will they continue to invest in cryptocurrency and lobby for regulation, or will they kind of put it to the side and look at different options? The bad news, O'Leary thinks the great cleansing is not over because we haven't really seen a cascade of panic events that he thinks define the bottom. He believes more crypto assets are headed for zero value. I do agree with that. And like I said, the DeFi contagion is a big worry surrounding Ethereum. Panic events define bottom, said O'Leary. In the crypto world, we need someone to go to zero. Now, technically, someone has gone to zero. Terra Luna has gone to zero. So that big event has happened. Let's not just ignore that as one of the events so that you can create an article that says it's going to get worse. Okay? You can't actually do that. It doesn't make any sense. But every day I put out a story that explains what's driving the crypto markets, and you can subscribe there. That's from Dan Runkenvisis or something like that. We'll just go ahead and ignore my inability to pronounce anything in my low-level Southern knowledge of names. All right. So what we have next is more news on Three Arrows Capital, and they confirm heavy losses from Luna's collapse and exploring potential options. One of the things that they are ignoring too on Three Arrows that is very important is their heavy liquidation of stETH. And once again, when we get articles like this, we have to pay attention to the fact that it's coming from the horse's mouth, but the horse may not really want to show its entire hand. It's a lot easier to tell you that there's a Luna collapse and that is what affected it, as opposed to admitting that what you did was purchase and stake a bunch of Ethereum and now you can't get that out because there's no liquidity in the pool left. It's a lot easier to say that, right? The company's co-founder said it's looking into the possibility of asset sales and rescue by another firm. Cryptocurrency fund Three Arrows Capital confirmed Friday it had suffered heavy losses in the recent market downturn and said it had hired legal and financial advisors to figure a way out, according to Wall Street Journal report. Quote, "We are committed to working things out and finding an equitable solution for all our constituents," 3AC co-founder Kyle Davies told the Wall Street Journal. The fund had over $3 billion worth of cryptocurrencies under management as of April. 3AC is exploring options including asset sales and rescue by another firm and hopes to reach a settlement with creditors, Davies said. 3AC owes at least $6 million to crypto exchange BitMEX as per a separate report by The Block today. Davies said 3AC invested over $200 million in Luna tokens as part of a $1 billion raise by the Luna Foundation Guard in February, an amount that is now essentially worthless since Terra ecosystem imploded in mid-May. The Terra Luna situation caught us very much off guard, Davies told the Wall Street Journal, but $200 million is nowhere near the $3 billion, right? 3AC was additionally known as one of the largest holders of Grayscale Bitcoin Trust and institutional Bitcoin product, as well as staked Ethereum, which is really the big issue here. We'll get into why in a second. Tokens, both of which have seen steep declines recently. Davies added that 3AC was working on quantifying its losses and valuing its illiquid assets, which include many venture capitalist investments in crypto startups. Meanwhile, Nicole Yeo, a partner of law firm Solitaire LLP, which is advising 3AC, told Wall Street Journal that it was keeping Singapore's financial regulator, the Monetary Authority of Singapore, apprised of 3AC's recent developments. The writing's on the wall for stETH, guys, and the fact of the matter is that it does have potential to spread across all of DeFi. And that is because obviously, really, we can relate that back to the merge of cryptocurrency. So it's hilarious that all of these investors that want to completely on miners, right, are actually being screwed over by the developers of Ethereum with the move to proof of stake and the way that they're handling it. Yet they're just going to keep continuing to blame everything on miners, who all they do is secure the network for a return monetarily. And until you realize and understand that manipulation that's going on and how that affects the broader market, I don't think you'll understand cryptocurrency, because you fail to understand the importance of the miners and you fail to see how it directly influences the market, specifically how it is portrayed in large outlets like Forbes. They always want to say, well, it's the investor's appetite. And they say we can't predict it. Yet, as miners, we can look at it and say the same thing happens every single time. So why don't you just shut up and actually report properly and do your research on how this is happening from a technical standpoint? And then you'll understand the importance of proof of work versus proof of stake. The biggest stETH pool almost empty, complicating exit for would-be sellers. One of those would-be sellers would be 3 Arrows, as we know, has not been able to liquidate all their stETH. And that's causing one of their larger problems that they did not report on to the Wall Street Journal. A trading pool that large institutional investors such as Alameda Research and 3 Arrows Capital have used to dump their stETH tokens is now nearly drained and heavily imbalanced, potentially trapping retail investors as well as embattled crypto lender Celsius. As cryptocurrency markets swooned in the recent weeks, large institutional crypto investors, including Alameda and 3 Arrows Capital, have used the blockchain protocol Curve to dump their holdings of a token known as staked Ether. The urgency came because the price of staked Ether tokens unexpectedly deviated from a supposed peg to the price of Ethereum. What is that at now? So let's go to CoinMarketCap and just take a look, right, at how much this is depegging, because this is going to be important. We've been calling it since before it started to happen. We told you guys it was going to happen, and it's really important to keep track of. Ethereum is at 10,081 right now. Let's go ahead and take a look at stETH and see if it's down below 1,000. That would be pretty bad. It is not. It's actually up right now to 1,098, quite surprisingly. So this is kind of getting interesting. Is that because it hasn't dumped enough, or there's no liquid? So there's where the reversal happens, right? You end up having stETH temporarily more expensive because there's none of it in the liquidity pool. I believe last we checked 80%, or sorry, there is a bunch of it in the liquidity pool, but you can't get it out because there's no ETH in the liquidity pool. So the price of that just kind of sits there. This is kind of getting interesting, guys. All right, so that's where we're at. It's still depegged, but it's done a reversal right now, as of right now. Okay. So the bigger, better known native cryptocurrency of Ethereum blockchain, which is the second biggest overall after Bitcoin. Now, however, the so-called liquidity pool in Curve that the investors use to get rid of their stETH is quickly drying up, a dynamic that might force future sellers into less transparent over-the-counter markets where discounts might even be steeper. The pool in question on Curve lets investors exchange stETH to ETH. Since nearly May, its total value locked, which is TVL for short, a common way of measuring the size of these protocols in decentralized finance, dropped to 621 million from 4.6 billion, data shows. It is also heavily imbalanced. That was actually a sneeze. It is also heavily imbalanced, holding almost 5 times as many stETH as Ether, making it expensive or impossible to swap large amounts of tokens. Because basically what happens is you go in there, and this is the reason why 3 Arrows Capital didn't liquidate all their stETH, is they go in there, they add the liquidity, and it only allows them to basically swap so much. You can see this in any liquidity pool. Actually, I have a quick example for you guys on Ergo Address, right? This is for a Neta, right? And then if we wanted to take Neta and actually swap it to SIG-USD instead, which is the stable coin, you'll notice the $75 is not equal to the $58 here. But if we drop this down to $75 worth of Neta, then at that point, or to $58 worth of Neta, then we would actually make a full trade. This is a liquidity imbalance between Neta and SIG-USD. However, if we go to a more popular token that has enough liquidity in it, you can see here that we have enough Neta, or we have enough liquidity between Neta and between Ergo to make our swap of $75. It's a lot easier to see on these smaller, newer startups for DeFi, especially on the Ergo blockchain. So I wanted to use that as an example so you understand. So if you come into one of these, right, and this is like Ethereum or stETH in Ethereum, you would have basically stETH up here and then, you know, ETH down here, and you're trying to swap 75 million or whatever it is for 75 million ETH, but you only have 58 million ETH available to you. Now, it's actually even lower than that now at this point, as they talked about, because as you can see here, 621 million from 4.6 billion is quite a big drum, right? So I feel badly for retail holders because the curve pool has been their only way out. Vance Spencer, co-founder of venture capital investment firm Frameworks, told CoinDesk in an interview. Institutions still can get their way out of this with the over-the-counter deals, although at a significant discount much higher than in the curve pool. So that means that they go off-chain, they start making deals with someone that actually has some Ethereum and starts dumping their staked Ethereum to outside holders, and at a very discounted price, right? And that means that, of course, you will end up driving the price of stETH down further once this finally hits, because there's no liquidity in the pools. The discount on stETH has been in an analyst spotlight as a telling sign of the recent liquidity crisis in crypto markets. One stETH represents an ETH token locked up on Ethereum's new blockchain called the Beacon Chain. During times of high inflation and aggressive rate hikes, investors prefer holding liquid assets that can easily be sold. The problem is that tokens locked up on the Beacon Chain cannot be redeemed in the foreseeable future until 6 to 12 months after Ethereum successfully completes a much anticipated upgrade to Proof of Stake network, often referred to as the merge. And based on the latest estimate from the top Ethereum officials, the merge isn't expected until August at the earliest, which we already know has been delayed till mid-September, but it's kind of up in there. They could do it earlier, of course, but mid-September is what they targeted via the EIP for the difficulty bomb 5144. Okay, so we're really looking at September at the earliest now, in my humble opinion, and maybe later, of course, according to people like Charles Hoskinson at Consensus 2022. Chase Devins, analyst at blockchain data platform Messari, wrote in a note earlier this week that stETH is in the early stages of its natural price discovery, and the discount will likely close when staked Ethereum is unlocked on Ethereum's Beacon Chain. When that staked Ethereum and it gets unlocked on the Beacon Chain, you will see a massive dump in the price of Ethereum overall. This is where the actual comparison between staked Ethereum as a wrapped token and Ethereum becomes extremely relevant. A lot of people are trying to say that the price of stETH does not affect the price of Ethereum, but they're completely inaccurate. It's just going to be a future projection of the price of Ethereum. And that is something that is going to be extremely important to pay attention to. The other problem with this is everybody's expecting the merge to happen so that they can unstake their Ethereum, when in fact, as we know, when we take a look at the roadmap from Tim Pico on his GitHub, it is very clear that there are no plans to unlock staked Ethereum for withdrawals post-merge. We know that will come in an EIP later with no announced date or time, or even an EIP written at this point. So that problem of the merge will unlock the staked Ethereum is a fallacy. This is another position where a lot of large news outlets are not reporting accurately, and it needs to get fixed. I wish someone would listen, because it's becoming extremely frustrating at this point. Until last month's implosion of Terra blockchain, stETH traded at a 1-to-1 ratio with Ether, but then a 2 to 3% gap of prices opened up. The gap further widened to 5 to 6% by early June in the wake of financial troubles of crypto lender Celsius and hedge fund Three Arrows Capital, both major holders of stETH. The transparency of the positions of Celsius and Three Arrows Capital had put those firms at a disadvantage, in the sense that short sellers knew how much to attack certain assets to try and cause liquidations. Lex Sokolin, head economist and global fintech co-head at Ethereum Developer Consensus, told CoinDesk in an email. Consequently, some of the larger holders dumped their stETH to get ETH, mostly using the Curve pool. Data by Kaiko showed that the stETH to ETH Curve pool was responsible for 98.5% of all decentralized exchange trading volumes in stETH in the last few months, while trading on centralized exchanges was negligible. Why would that be? Well, that's actually pretty easy to determine. The reason why centralized exchanges are not having it is because centralized exchanges, for the most part, have completely shut down swapping for this. So the only places to actually do the stETH trades, right, because they're actually able to back it, because there's some ETH there to actually support it, is going to be your DeFi like Curve, Uniswap, SushiSwap, etc. So that is why that's happening, right? The centralized exchanges do not have this ability because they don't have any way to get their ETH out of the stake that they've put it into. Amber, a crypto investment platform, pulled out $160 million within days in early June, according to the Kaiko report. Alameda Research, a digital asset trading firm, sold $88 million in stETH, and Three Arrows Capital, the hedge fund that faces a potential insolvency, redeemed about 400,000 ETH and stETH tokens from the protocol in May. The reason liquidity providers left is that once the peg broke, they got a terrible deal in that they were selling ETH too cheap, said Bob Baxley, Chief Technology Officer of automated market maker Maverick Protocol. As the pool became imbalanced, they did not want to get trapped only holding illiquid staked ETH. As a result, the Curve pool has lost 85% of its value and holds roughly 111,000 ETH and 492,000 stETH, an indication that many more investors want to sell stETH for ETH than the other way around. Celsius, a big crypto lender, now under scrutiny since it halted withdrawals, citing extreme market conditions, might be trapped with its stETH holdings. Celsius still holds at least 409,000 stETH, worth about $413 million at current prices, according to data provided by 8board, a portfolio tracker from the blockchain analysis firm Nansen. The stETH ETH Curve pool only has about 110,000 Ether, meaning there is simply not enough tokens to swap stETH into. So you see here, they have 409,000. But if we look at the liquidity pool like we were talking about, there is only 111,000 ETH to be traded. So in a liquidity pool, because it's DeFi, there has to be a staked amount equal to, of course, this amount. So somebody would have to come in here and add another, for them, right, to get rid of this, they would have to add another 300,000 or so stETH to liquidity. The problem is when you add liquidity like that, you're having an issue where you end up with kind of an imbalance as well. What would have to happen is the current liquidity providers would need to basically get out their staked ETH and then rebalance the liquidity pool, but then they're stuck with a whole bunch of staked ETH that they would have to swap themselves, and then at that point you end up with the imbalance once again. It's a problem for DeFi for sure. Celsius couldn't have sold all of their stETH on centralized or decentralized exchanges, and as a result likely had or will have to resort to an over-the-counter type transaction in an effort to remain solvent, Kaiko's writer wrote in a note. Average investors who want to get rid of stETH may have even fewer options since they typically cannot access over-the-counter markets to strike a deal. Centralized exchanges don't have enough market depth for stETH and ETH trading pair for those who want to sell. Here's the stETH US market depth, and as you can see, it's taking a huge dip. The only way out left for retail investors is the Curve pool, which has been rapidly shrinking by 10 to 15,000 ETH a day this week. Assuming that rate continues, the pool will be fully drained within 2 weeks. We have 2 weeks before that's fully drained. So, not financial advice. My prediction, we will see a huge depegging between Ethereum and staked Ethereum within about 2 weeks. So Friday, 2 weeks from now, we'll go ahead and take a look at it and we'll let you guys know if that little prediction is correct. I'm feeling that it may be. Assuming that the rate continues, and at this point also, they're just running out of the ability to trade what they need to. 110,000 or 409,000 with only 110,000 in the liquidity pool. Bitcoin recovers to 21K as Fed commits to slow inflation and traders remain cautious. I want to say thanks for all the super chat stickers. Make sure you hit that like too while you're down there. And those super chat stickers apparently help the algorithm a lot, so I appreciate it immensely. Boom. Fed Chair Jerome Powell said the agency remained committed to reducing inflation and increased interest rates by 75 basis points earlier this week. We talked about it yesterday. I believe, actually, I pulled up the wrong... No, this is the right one. This is the updated one. Okay. Bitcoin rose above 21,000 in European hours today as broader financial markets in Europe and Asia advanced after Friday's open. The recovery followed a record 9-day slide that caused the Bitcoin price to fall from 31,000 in early June to just over 20,000. Bitcoin has slumped almost 70% from a November lifetime high of 69,000 US dollars. Among equity markets, Hong Kong's Hang Seng rose about 1.1%, and Shanghai Composite added nearly 1%. German DAXs gained 1.41%. And the stocks Europe 600 advanced 1.22%, while the U.S. index futures also gained. The recovery in markets came as traders assessed the long-term impact made by Wednesday's U.S. Federal Reserve decision. Fed Chair Jerome Powell said the agency remained committed to bringing down inflation and increased the interest rates by 75 basis points, causing a brief relief rally in global and crypto markets. Quote, although a 50 basis point hike was anticipated for many weeks, last Friday's inflation data forced the market to price in a more aggressive hike with huge sell pressure. Marcus Soterori, I don't know, I apologize, I can't do it. An analyst at crypto broker Global Block said in an email, therefore a 75 basis point hike was priced in for the short term, leading to a rally. He also added that there could be more downside in the next few months after this week's rally cools. This is due to concerns around an earnings recession on the horizon as a result of the Federal Reserve's aggressive monetary policy. According to Bank of America, stagflation fears are the highest since 2008 and profit outlooks are the worst since the GFC, global financial crisis, too, he said. The negative environment could cause an uptick in foreclosures and bankruptcies. I posted a little meme on the locals page, I believe this morning, and it came from, I believe, Mr. Elon Musk. I don't recall exactly, but I had seen it over there. I'll show you guys this real quick. This is a meme that says stocks, cryptocurrency, and now the Grim Reaper knocking on the door of real estate. There's one decision I made that a lot of people give me a hard time about in this current market, and that is that I did not purchase a house. I rented a house, and the reasoning for that was because obviously the housing prices were high. Now, you could say that was a mistake in general, but I also signed an extremely long lease all the way until I can get into the next bull run cycle, and that locked me into pricing on rent. Whereas when you're dealing with mortgages rates, and especially like unsecured mortgages or that sort of thing, you can put yourself in a really nasty position. So that was one thing that I did that I think was probably beneficial for now, because I do worry that we are potentially going to see some real estate issues, right? That being said, let's continue. The negative environment could cause an uptick in foreclosures and bankruptcies. Susanna Streeter, senior investment and markets analyst, Hargreaves Lansdowne, seconded the sentiment. There is unlikely to be sustained relief from the sinking feeling that has hit financial markets this week, she told CoinDesk in an email. After the initial boost of optimism that the Federal Reserve was going to get a handle on inflation with a 0.75% rate rise, the mood soured on Wall Street as concerns mounted that the price spiral was going to be an even harder nut to crack without fresh aggressive hikes. Some, like Alex, an FX senior market analyst, maintained a bearish outlook for Bitcoin in the short term. The bearish focus remains on the $20,000 level, the former peak of 2017. Oh, are people actually calling this now the way I talk about it? If we're talking about the halving cycle, what do we expect? We expect the bottom of the next cycle to be the top of the previous cycle. The top of the previous cycle was around $20,000, and now that would be where we sit at the bear market until the next halving happens on Bitcoin in 2024. The analyst added that uncertainty surrounding cryptocurrency fund Three Arrows Capital could result in contagion risk amid growing speculation about its possible bankruptcy. The fund is said to have faced at least $400 million in liquidations after failing to meet collateral requirements on its levered positions, as previously reported. Once again, what I think you might see is we could see a complete destruction of the rest of the cryptocurrency market and Bitcoin just standing there all by its lonesome. That is a possibility. Let's go ahead and run one more ad for you guys today, and then we're going to get into the mining profitability and questions and answers. Today's sponsor is Crypto.com. Crypto.com is my go-to centralized exchange for liquidating my crypto assets. With their Crypto.com Visa debit card, I can load up my mined Ethereum to pay for power and other operating costs quickly while earning up to 8% cash back. In addition to the Visa debit card, there are additional fiat options, including wire transfers, to easily receive your profits. Crypto.com also offers additional services, including trading and even staking, to earn additional revenue on your investments. Join 10 million plus users buying and selling 100 plus cryptocurrencies at true cost by using my affiliate link in the description for a $25 funding bonus. Or enter referral code SOAT at sign up for the same bonus. Remember, cryptocurrency investment comes with significant risks, so do your own research. Alrighty, so let's get into mining profitability. As you guys may or may not know, I have moved to mining Neta through Ergo Smart Pool on GetBlock. We also did a guide for it this morning. While I was definitely making more revenue for the short term, at least over the past few days, today is not looking as good, but it's not terrible, right? So we're at 9,400 Neta. And that is pretty much the amount of Neta we've made in the past 24 hours. So we have had a full 24-hour cycle now to kind of start analyzing this. We're going to be sitting on this till at least June 29th. So you guys will get this kind of overview of what's going on here. Why are we mining Neta? What is Neta? That sort of thing. A brief overview is that Neta is going to be basically a way to have wrapped Bitcoin on the Ergo blockchain. So Ergo is a similar platform to Ethereum. Hold on, but it's proof of work. And hold on, it also has basically backing and sort of, I suppose, respect from Charles Hoskinson from Cardano, which for a proof of work coin is pretty good. And it is probably the most advanced coin to come out of the previous cycle. So when I talk about that, what I mean is it's had the most development. What it's had is essentially already caught up from a technical perspective to Ethereum, from the DeFi perspective, from the NFT perspective, all of that. There are some questions I have and some kind of, I guess I'm a little wary of a few things going on with it from its monetary policy that we've talked about before, as well as on the SIG USD front as an algorithmic stablecoin. We'll talk about all of those later on. It's very early though in Ergo. Neta, like I said, aims to have essentially the Bitcoin, wrapped Bitcoin for Ergo, for Cardano, I believe as well. So you have those going on. Ergo will also be on their Ergo DEX, having the ability to swap between Cardano. So it'll be a nice, happy little pairing going on there, which should make liquidating Ergo a lot easier than most other coins, i.e. something like even Flux. Probably Flux is number one easiest to liquidate outside of Ethereum. I would say Ethereum Classic is a little bit easier, except their confirmation times are very long. Anyways, Neta right now has kind of structured their build up in a unique way. In most cases, when you have an initial token launch on a platform, there is some sort of airdrop, that sort of thing, and it usually ends up being unfair going to developers, insiders, etc. What Neta has done is they've set aside basically 22% to go ahead and pay out to miners. They're doing this through GetBlock, and I think this is an amazing way. This is going to be the first token ever to really focus on miners from that perspective. And what they're doing, what that benefits for them, is they're taking the block reward that the miners get of Ergo and using that to add the liquidity so that they can build up, of course, the liquidity for their project. And I think that makes a lot of sense. Right now, the basic of it is that you are getting 20% or 22% more Neta or value of your Ergo that you mine. So you mine 1 Ergo, you get 1.22 Ergo in Neta. And this will create obviously some other stuff tokenomics wise that will go into more depth. I've been working on a video. That's just a brief overview. So I am mining it. I could be completely wrong, and this isn't financial advice, etc., etc. There is a guide, though, on a technical how-to if you want to check it out. Over the past 24 hours, we've done 9,483 Neta on 12 gigahash. And they're still working on the API here, to my knowledge. You can see that right now, it's still all of this isn't really estimating out as far as weekly, monthly, all time. Make sure you click the personal stats if you're trying to look up your own, and then you can check out the guide for the rest. If we wanted to check out the value for that, of course, we can come over here to the Ergo Dex, and it's 94.83, right? So 94.83, that would put us at about $76. Let's make sure we swap that to Ergo if we wanted to do that. But you would have essentially $76 for the farm. In relation to Ethereum, what would that be? Well, this is about 4,500, about 4.5 gigahash. So we can calculate that out and see what we would get on Ethereum. If we were mining Ethereum directly, we would get 62.18 in revenue. So right now on Ergo, getting Neta, we are making about $13 more a day than we would if we were mining Ethereum directly. And I think that is valid to go ahead and point out, because a lot of people are asking, is it coming out to being more profitable? Yes. Even with this low turn in it, we are ending up more profitable. Your liquidation is going to be a little bit more complicated. And obviously we'll be covering this and making sure this lasts out long term. But it is something that is going to be extremely beneficial in my humble opinion. You could mine Ergo directly as well. So let's go ahead and check out those numbers on Autolicos. If we added the 12 gigahash or something like that, is that right? 12 gigahash? Yeah. On Ergo, we would do $69.46. So we're doing about, or $70. So we are doing about $6.43 more, not quite 20%. That's more like 10%. So what's going on there? Well, what's going on there is that the pool distribution for Ergo has basically GetBlock a little bit lower. So if we took a look at mining pool stats, you'll see here the GetBlock is moving up. It's up to 720 gigahash a second. But compared to like Nanopool with the 6 terahash a second, it's nowhere close compared to a lot of these other pools. 2 miners being a really popular option is at a total of like 5 terahash a second. That means that competing with those pools, it has to find as many blocks, which means that it's a little bit more difficult. The more hash rate that gets moved over from other pools to GetBlock, the more all the miners will make if they are using the Neta option, because they will get that 22%. More blocks means more rewards, and it's just better for the pool to have more hash rate. I am not sponsored by GetBlock. I do not have any affiliation, which means as far as like getting paid in any form or fashion outside of the mining that I'm doing on the pool is not happening at this time. There are talks though of setting up a Son of a Tech sub pool. What I have to work on is getting the funds built up for the Neta smart contract, because if I do a sub pool, I want it to be Neta. We'll talk about that in a later video. I've been talking about that with GetBlock though, and hopefully we can figure out something as far as that goes. Anyways, that's my mining profitability for the farm. We do have a couple rigs offline. We are waiting on restructuring due to the heat, as we are in Texas, and that is pretty expected. Let's take a look though at the rest of the hash rates going on the networks. Bitcoin being the first, of course. Let's go ahead and pop on over there. And Bitcoin is at 222 exahash a second. It's down even further from yesterday. As expected, with the price of Bitcoin going down, we are now seeing the hash rate of Bitcoin going down on the network, as well as hopefully the difficulty will start responding to that soon. And this is good news because what we're seeing is the traditional halving cycle taking place. And I'm happy to see it. It means that we can actually start to find solace in the fact that we will see a recovery in 2024, not dissimilar from the previous one. Let's take a look at Ethereum. Ethereum is at 982 terahash a second. It's still holding steady from yesterday, maybe down about, 8 terahash a second or so, not too low. Ethereum Classic is down to 23.52 terahash a second. Let's take a look at Flux. Flux is at 1.36 mega solutions a second. And let's take a look at Ravencoin. Ravencoin's at 2.37 terahash a second. Take a look at mining pool profits. For the last 90 days, Ethermine in first, Crazy Pool in second, and F2 Pool in third for Ethereum. Last 60 days, Ethermine in first, Crazy Pool in second, F2 Pool in third. Last 30 days, ZET in first, Crazy Pool in second, Ethermine in third. Last 21 days, ZET in first, Ethermine in second, Crazy Pool in third. Last 14 days, ZET in first, Crazy Pool in second, Ethermine in third. Last 7 days, ZET in first, Crazy Pool in second, Ethermine in third. Last 3 days, ZET in first, Crux Pool in second, Crazy Pool in third. And for the last day, ZET in first, Crazy Pool in second, and Nano Pool in third. Mining ASICs, mining profitability. Let's go ahead and pop into here on MinerStat. Scrolling down, the KD6 is at 2106. That is up a little bit from yesterday. We have the Antminer L7 at 1757. The KD5 at 1333. Once again, up since yesterday. If we scroll down, take a look at the S19 Pro. It is up, but not by much. $3.54 a day on mining rig rentals. ASICs taking a pretty big hit. And that is translating into sales. BT Miners is one of the sponsors, so make sure you check them out via the affiliation link. And that is translating into a reduction in pricing. We're down even further a little bit on the S19 Pro, which is down from $6,000 yesterday to $5,800 US today. We are bottoming out on prices on some of these miners due to how much they purchased them for. So for example, the V1 Mini Classic was $1,700 and $1,350 and hasn't seen another dip. We are also seeing similar things happen with the WhatsMiner M30S, which is 104 to 110 terahash at 7,834. They obviously had not hit the bottom price on the S19 Pros yet, so they're at $5,800. And that is basically probably getting extremely close on their margins. So that is why you're seeing those dips come down there. Let's get into questions and answers. Remember, super chats are never required, always appreciated. First to get answered because they are highlighted. If they were posted earlier in the chat, I may miss them, so I apologize. Just tag at Son of a Tech, which will highlight the message orange or the beginning of the message orange, making it easier for me to read. Super stickers are the best for the algorithm, and if you want to support the chat or the channel directly and make sure all of your funds are going to me and not getting a cut to YouTube or anything like that, you can support me on sonofatech.locals.com. All right, all the plugs out of the way. Let's get into questions and answers. So we have one super chat from Stiggy for 50 NOK. Says, what are the white spots on the picture of Elon Musk's face? I don't know what that means. I guess you're just saying, I get it. All right. Ranja Patel says, $5 super chat, says, where I buy Bitcoin, Binance. You research, but only video, old man. Also is Yo ROI safe. Yo ROI has quite a few problems as far as like functionality. I had swapped to Nautilus for my Ergo, but it's not necessarily unsafe. It's just unreliable is what I would put as far as that goes. All web browser wallets are going to be less safe than, of course, hardware wallets or paper wallets. So you keep all of that in mind. As far as where to buy Bitcoin, it really depends on your region, which exchanges you can use. I assume at this point you may not be from the US, so I couldn't really tell you other than like my specific locations. Obviously, the sponsor today is crypto.com. They are available in many geographical locations, and make it easy to buy Bitcoin so you can sign up with my affiliate link SOT. And if you fund a card, you get an additional $25 on your sign up. So there's that. We have super chat stickers from Miner7D. Thank you, $9.99. And a super chat sticker from Panzer for the 99 cents. Let's go ahead and I'm going to get this chat popped out so I can read it a little bit easier and bring it over here. I want to make sure I didn't miss any of those other super chats. We have a $1.99 super sticker from Xcraft LLC. Thank you, good sir, says new. And a super chat sticker for 99 cents from Ted Park. Thank you, good sir. And then Wasted Trash Panda says, stop blowing your BS Texas heat up here to Arkansas. My single wide is an effing frying pan. Yeah, man, it's getting hot out here these days. I'm sweating in my office 24/7. It's absolutely insane. All right, so Ulysses says, as I'm a tech smart man, I'm in the mortgage industry. The recession is going to be a perfect time to buy. Opportunities are going to open up everywhere. The ability to capitalize on those opportunities while maintaining your lifestyle is going to be nearly impossible. So you may want to look into reducing your lifestyle costs, which is something I've been looking into. LZ says, as I'm a tech, my rigs are running a lot cooler on Ergo. Not sure about Neta. Is it comparable being I'm paid in Polygon on Matic? Yeah, so it's essentially, well, it's a little different. So instead of mining a side chain or getting paid out, a side chain in the original price, you're mining on the primary chain and getting paid in a token. Ergo is what you're mining. You're not mining Neta. Neta is what you're getting paid out in. So your overclocks, everything else is the same because you're just mining Ergo. Mark says, as I'm a tech, how do you update AMD GPU drivers on BIOS modded cards? BIOS mods shouldn't affect the update to a certain point. So if you're going back to like Polaris GPUs, there is you don't want to update to the latest BIOS. For the rest of the cards, well, there's not really many BIOS mods that you can do on 6,000 and up. 5,000 series has a limit too. I forget what the numbers are, but you can Google them and find them, typically on Tech Power Up. Detroit Iris says, as Son of a Tech, is Neta pegged to Ergo, or does its value fluctuate? If it's not pegged, is the 122% accomplished during mining or during conversion? So it's during the conversion, and they make sure that they have that available at all times. And the peg is not to Ergo at all. So there's no peg to Ergo, and that price can fluctuate. Sean Voltez says, as Son of a Tech, FYI, Ergo EIP 27 passed. Emissions issues should be addressed. Thank you, good sir. LZ also says, at Son of a Tech, so is the great hash rate migration a thing of the past because migration shutdowns already started? At this point, the market has started doing its thing, right, LZ? I don't think that we're going to have to modify or do anything from that perspective. I think that it's naturally taking its course at this point. I have a couple ideas, but nothing really in the pipe right now that I can speak to because I think that from an ops perspective, I can't figure out exactly what we need to do to prepare more, right? Dan Sand says, as Son of a Tech, in addition to 22% more, you also can discount the not need to pay Hive to mine ETH since mining Ergo is free on Hive. I'm not clear if mining Ergo on Hive is free. I hadn't heard that. That's pretty interesting and cool if true. Got sometimes talking for an hour can get a little exhausting, huh? We have a couple more questions and then I do have to shut it off for Father's Day weekend and jiu-jitsu, of course. At Son of a Tech, hi brother. Hi buddy. Says, after so many delays in the past years, do you think Ethereum merge is actually going to happen? I think it's a lot closer and I think it will happen. I think it does have to happen. It either has to happen or they have to Look, damned if you do, damned if you don't at this point. That's where it's at, frankly. Kind of Ethereum is just... I wouldn't place any bets from the mining perspective on Ethereum no matter which way it goes. Emmanuel says, ask Son of a Tech, what can't ASICs be repurposed for other algos? Why can't they? Because they're specifically programmed to do one thing. ASIC stands for application-specific integrated circuits. So when we're talking about an ASIC, it's for a specific application. And so it's programmed for a specific algorithm, and that's why they can't be reprogrammed for other algos. It has nothing to do with just software. It also has to do with the hardware. Jay Great says, outside of a tech, what happens if those who have staked ETH pull it out before the merge? Or is that not possible? Well, that's what you're seeing happen right now. The only ETH that you can pull out pre-merge, or let's not stop it real quick. Hold on. Let me correct something first. Okay. You can't unstake your Ethereum post-merge either. Okay. Like you can't. That's not physically possible because they do not have that built into the code. All right. So let's get that out of the way. You need to understand the nuance surrounding this is when we talk about staked Ethereum, stETH, right? And then staked Ethereum, they're two separate things. Staked Ethereum is going into a node that is locked up until they enable withdrawals, okay? stETH is a token that is wrapped on the Ethereum blockchain that represents the Ethereum that is staked that nobody can withdraw, okay? stETH is what people purchase to not have to actually lock up their own ETH, but get some sort of advantage from the staked ETH return rate, which is already so low. I don't know why you would do that. So on a liquidity pool, what happens, like we showed earlier in the video, is somebody puts up some ETH to basically pair with the staked ETH. And this is the only way in which on DeFi somebody can withdraw their staked Ethereum or their stETH, not necessarily staked Ethereum. You can't withdraw that. This is the only way you can withdraw stETH, which is representing the ETH that is locked up, which actually isn't in existence. But there are people that set up a DeFi pool that allow you to move some of the ETH that isn't staked over, or basically swap your stETH for the ETH that isn't staked, the actual ETH that isn't staked. What is happening right now, as we see with Three Arrows Capital and of course the Curve pool, is that now we have a position where in that liquidity pool, 20% of it is actually Ethereum and 80% of it is staked Ethereum. So whenever somebody tries to trade for the actual Ethereum, the stETH, they can't actually get all of their stETH traded out. And this is why we end up in the position that we are in. What would have to happen, like we've talked about before, is that your staked Ethereum that is actually staked, real Ethereum that's staked, has to be put back into the market and added to that liquidity pool so people can get the wrapped version of staked Ethereum out. I understand that it is complicated, and that's the best way that I can explain it. That just means that basically, no, we're all f***ed, though, at the end of the day. Matt Plumey says, ask Tech, any idea when your Ergo setup video will come out? It came out at 6 a.m. this morning. Dan Sand says, ask Tech, check your Hiveman dashboard to see if they are charging you for mining on Ergo. I will. I don't have it logged in right now. Gallo says, ask Tech, tempted to mine Neta. How long do you think it'll take for Ergo's difficulty to show the new hash rate coming in? It takes about 3 to 4 days. MD says, ask Tech, did you find anything out about supposed Ravencoin fork? I have not. Gerardo says, ask Tech, what cooling do you have on your farm? None. And I have considered evaporative and swamp coolers. I think moving air is more beneficial. Thanks everybody for watching today. I'm going to head off to Jiu-Jitsu. Be sure to hit the like, comment, subscribe, and the notification bell. Share the show out with all of your friends, family, and colleagues if you find it helpful so that they can get true, unadulterated news on cryptocurrency with nuance involved and the actual technical backing to back it up, because frankly, the rest of these outlets are missing a lot. And I hope that you guys are seeing the value of following the channel so you get a better explanation of what's actually happening. Love you all. I'll see you next Tuesday.